So I think we are right on time, so that's good. Um, all right, it's a real pleasure to actually introduce the speaker for today's Luohan Academy webinar, Isaiah Andrews. Isaiah is the Charles E. and Susan T. Harris Professor of Economics at MIT and also a research associate at the NBER. He is just one of the leading econometricians of our generation, and his work on inference robustness has had a profound influence across many areas in our empirical research. And his contributions have been recognized, of course, with many of the field's highest honors, including the Clark Medal, the McCarthy Fellowship. He's also elected as a Fellow of the Econometric Society. I think that the honor list goes on. And today, he's presenting a joint work with Mayim Fabudi, who's also a professor at MIT, that asks what I would call a deceptively simple question. Do markets believe in transformative AI? So they're going to use event study design around major AI releases, and also look into the financial market, especially long maturity bond market. Uh, and he's going to present to us perhaps surprising answers to the question. And as I was preparing this introduction, I did what any responsible economist in 2026 would do. I asked ChatGPT whether I was missing anything important. And it actually confidently told me that I wasn't, which of course made me slightly nervous. But that does feel like a appropriate way to start a discussion about AI, about beliefs and markets. So Isaiah, we're delighted to have you here, and the virtual floor is yours.
Fantastic. Thank you very much for that extremely kind introduction, Will. So today I am presenting the paper, Do Markets Believe in Transformative AI, which is joint work with Mariam Farbudi. And I should say there is a working paper version of this paper posted, but we're actually in the process of revising it to add some new results. So with apologies, some of the results I'll show you in this presentation aren't yet in the posted paper, though I hope that they'll be there in the next month or two. Okay, so the basic question, we're starting out from here, is what investors think is going to happen with progress in AI technology. As I'm sure I don't need to tell any of you, AI has been an extremely fast-moving technology, and there's been intense and diverging speculation about the impacts that AI is likely to have on society. Just to take the names of a couple things that folks have written on this, on the one end of the spectrum, we have machines of loving grace. On the other end of the spectrum, we have if anyone builds it, everyone dies. The predictions of AI's impact on economic growth have likewise been pretty divergent, with some observers predicting unprecedented prosperity, while others arguing that AI could have little growth benefit or even generate widespread unemployment. And the question that we're interested in this project is, it's easy for folks to say, right, a wide range of things, but when we look at the decisions folks are actually making, what can we say about what it is that they seem to believe? And in particular, we're going to look at the beliefs of investors, at least insofar as we can understand them, by looking at asset prices. In particular, we're going to be interested in the possibility of transformative AI, by which we're going to mean AI with a large and sustained impact on living standards, where that could be through things like dramatic increases in consumption growth on the one hand, or existential risks on the other. The premise of our analysis is that if investors think transformative AI is plausible, right, if they think that AI could dramatically increase the rate of economic growth or kill us all, that should have an impact on their forward-looking decisions and thus on long-run asset prices. In particular, in this project, we're going to focus on bond yields. The reason being that if you take just very simple consumption-based asset pricing models, they tell us that the yields on risk-free bonds are directly informative about the expected stochastic discount factor. basically how much I'm discounting tomorrow or 10 years from now relative to today. Moreover, there's a very nice observation in the earlier literature by Basil Halperman and some of his co-authors that both higher growth expectations and larger existential risks, at least perceived existential risks, should raise interest rates. And basically, the argument is, if I expect to be very rich in the future, well, then that decreases my incentive to save today, so real interest rates should rise in equilibrium. Similarly, if I think that in the future there's a non-trivial chance that AI kills us all, well, then that also decreases my incentive to save today because I don't expect to be around to consume those savings in the future. So again, equilibrium real interest rates should rise. Now, that clean prediction for risk-free assets is in contrast to stock prices, right? Where the predictions, sort of what you would get as the prediction for equity prices from an increase in the expected growth benefits of AI becomes more ambiguous. So that's one reason why here we're going to focus on bond yields. In particular, we're going to focus on changes in bond yields around a set of major AI model releases in the period from November 2022, shortly before the release of ChatGPT, through the end of the last calendar year. So to not hide the conclusion, here I'm showing you, averaged across the set of model releases on our sample, the change in bond yields on Treasury zero coupon bonds with maturities ranging from 1 to 30 years over the period from 30 trading days before the model release up to 30 trading days after. What we see is that from, over the period, say from 30 days before to 15 days before the model release, there's not a lot of movement in bond yields. But starting around 15 days before the model release, we see a large decline in the yields on these zero coupon bonds, where that decline persists all the way through the end of the event window 30 days after. There is also some pattern in the magnitude by maturity, but I'm going to hold off talking about that for a moment until I can get to sort of our main regression specifications later. But the main point is, at least on this first cut, it does seem to be the case that bond yields are in fact falling around the major AI model releases in our sample. And for most of this paper, most of this talk, I'll be interested in sort of, number one, trying to convince you that this is in fact actually happening. And then number two, trying to give some initial thoughts on why this might be happening and what it might mean. Okay, so with that, I'll start by talking about our data and methods in more detail. I'll then talk about our empirical results, briefly try to interpret what we're finding through the lens of a very simple model, talk about results for some other financial series, and conclude by talking about some robustness and wrapping up. All right, so for the purposes of our analysis, we would like to have a set of dates around which we think that new information about the capabilities and perhaps future trajectory of AI progress arrived. And in particular, what we're going to do is to focus around the release dates for new flagship generative AI models from a set of major AI labs. In particular, we were able to grab historical rankings from LM Arena, which is a leaderboard, basically ranking various LLMs on their performance on various tasks. For the dates we were able to grab, we're going to look for each lab at the percentage of the days when it had at least one model ranked in the top 5 models on the leaderboard, at least one model in the top 10 models on the leaderboard, and the best rank that the model attained over those dates where we were able to get the historical data. Right, when we do this, we see that there's a fairly strong distinction between the top 4 labs here and the rest in the data. Right, where, for instance, these 4 labs, OpenAI, Google, Anthropic, and xAI, had at least one of their models in the top 5 at least 40% of the time, and at least one of their models in the top 10 over 60% of the time, where both of those are substantially larger than the remaining labs. So for that reason, we're going to focus on changes in bond yields around the dates when these labs released an update to one of their flagship models. Now, on financial data, we're going to focus on, first, constant maturity zero coupon treasury yields. right? So these are nominal, non-inflation adjusted treasury yields, where for a lot of results, we'll sort of focus on maturities 1, 2, 5, 10, 15, 20, and 30 years. And as a complement, we'll also focus on zero coupon TIPS or US Treasury inflation protected securities, where these are inflation adjusted. They're intended to be real bonds protected from inflation. And the maturities we'll focus on here, since we don't have 1 year or 30-year maturities, are 2, 5, 10, 15, and 20 years. We're also going to use some belief data later in the talk, where these beliefs are trying to capture information about sort of what do people think is the information about technological growth embedded in these AI model releases we're studying. Specifically, here we'll be using data from the online prediction platform Metaculus, where the particular question we'll focus on asks sort of folks making predictions about when they expect the arrival of a particular definition of artificial general intelligence, or AGI. Metaculus is a prediction platform where you basically have folks on the internet submitting their predictions for when they think things are going to happen, and basically being scored on how accurate are their predictions according to scoring rules. It's not a betting market because there's not a monetary payoff, but you could think of it as similar in spirit, where folks are trying to do a good job on prediction. And the thing we'll be focused on here is the impact of AI model releases on forecasts. In particular, do we see that around a given model release, the forecast timeline shifts faster, right? That is, the expected arrival date for AGI shifts closer to the present, which we would interpret as saying that release conveyed positive news about AI technological progress, versus slower, right? The arrival date of AGI getting pushed back, which we would interpret as saying that the model release contained negative news about technological progress in AI. Time permitting, at the end, I'll also show you results for some other financial series, such as corporate bond indices, corporate bond spreads, trade-weighted US dollar index, US sovereign credit default swaps, and treasury volumes. All right. I saw there was a question, but Will, would you, if there are questions in the chat, will you jump in to convey those?
Yeah, I'll collect some questions. Yeah.
Oh, fantastic. Great. Thank you very much. All right. So with that, let me jump into telling, unless there are questions we should pause for right now, I can jump into telling you about the methodology. Great. All right. So looking at major releases from the set of labs I outlined before over the time period we're looking at, we end up with 30 model release dates. So let's collect those model release dates in a set of dates, say script T, with individual release dates tau. We're going to be interested in the change in bond yields from B trading days before a model release to S trading days after. Now, because we're using these relatively long windows around each of the model releases, these event windows are going to overlap, especially in the data from last year when there were a larger volume of model releases than in the previous years. So to account for that potential overlap, we're going to use a regression approach. Specifically, we're going to look at the first difference in the bond yield series, and we'll regress those first difference bond yields on a constant, then the sum over model releases in our data, then a sum over relative time dummies for time relative to those various model releases. So here, alpha L can be interpreted as the change in bond yields associated with being L days from a model release. And right, this structure handles the fact that, for instance, a given date could be, say, 10 days after one model release and 15 days before another, in which case both the relative time indicators for 10 days and 15 days would be turned on. The main test statistics, or sort of summary statistics I'm going to show you, are then going to be these beta hat H's, which cumulate these relative time coefficients, alpha hat L, from 30 days before the model release, or B days before the model release, up to H days in relative time. Right. So for instance, this could cumulate these relative time dummies from 30 days before the model release to 29 days before, 28 days before, 27 days before, and so on. Now, let's suppose I run this regression and these cumulated effects beta hat H suggest yield responses. That is, they suggest that bond yields are in fact moving around these AI model releases, consistent with sort of that initial plot I first showed you. Well, a natural question to ask is whether the changes in yields we're seeing are larger than one would expect due purely to chance. After all, right, there's a lot of other things happening in the world that potentially affect bond yields. So simply because we see some movement in bond yields doesn't necessarily tell us that sort of we should think of that as due just to AI. More complicating that, we also only observe about 3 years of data, right? And consequently, large sample approaches to inference, so things like standard errors or t-tests, which rely implicitly or explicitly on an assumption that our sample size is going to infinity, seem unlikely to be reliable in this setting. To avoid that, we're instead going to focus on 3 small sample inference methods, so methods that are valid even in finite samples. The first being permutation inference, the second being a time shift inference method I'll describe in a moment, and the third being rank correlation across events. These methods have different strengths, but for the sake of time, today I'll focus on the first 2, so permutation and time shift inference. So for permutation inference, the idea is, suppose we were willing to assume that the timing of a given model release within a given year is as good as random, and moreover, that bond yields do not respond to the AI model releases. Well, under those 2 assumptions, you can show that these sort of coefficients beta hat H are going to have the same distribution as if we just drew model release dates at random. Consequently, that immediately suggests a test, which is that we can draw placebo event dates, say tau star, uniformly at random within each year, where in doing this, we'll fix the number of events in each year. So we'll fix the number of releases in 2022, 2023, 2024, and so on, to account for the fact that sort of the frequency of model releases is trending upwards over time. For each draw of these placebo event dates, we'll then compute placebo test statistics, basically running our regressions, but with these placebo dates, call them beta hat H star. We'll repeat this many times to get a distribution of these placebo coefficients. And then we'll compare the real test statistics computed on our actual model release dates to this placebo distribution. If we find that the test statistic computed on the real model releases falls outside the middle 95% of the placebo interval, that tells us that the yield changes are statistically significant at the 5% level, in the sense that they are unlikely to have arisen by chance, right? They have less than a 5% chance of arising by chance if A and B are both true. I will then summarize this information using p-values, where a p less than 0.05 is going to tell us that the result is statistically significant at the 5% level. Now, one limitation of this permutation approach is that it doesn't allow for time series dependence in the model releases, right? For instance, it rules out that one lab releases a model, and then in order to stay competitive, another lab races to release their next model earlier than they otherwise would have, right? In particular, since we're drawing the placebo model release dates at random, we're sort of ruling out those sorts of interactions. Time shift inference is an alternative inference approach that we'll also use that's going to let us relax that assumption. For time shift inference, what we're going to do is we'll fix the model release series at whatever it is we observe in the data, but we'll shift the yield series forward or back in relative time. That is, the placebo draws here are going to replace the actual yield series with the yield series shifted forward or back by kappa periods, where kappa is going to range over some interval from minus r to r. There's a nice paper in biology, actually, which shows that this is going to yield a valid test for statistical independence of model releases and bond yields, provided that the first difference yield series is time stationary. And second, provided we are a little careful in how we calculate the critical values for these tests, right? Essentially, we're going to need to sort of use quantiles further out in the tails of the placebo distribution than we otherwise would in order to account for dependence across the yield series. Now, The benefit of this relative to the permutation approach is that, as I said, it allows for there to be serial correlation in these model releases. The downside is that, first, it's going to tend to be conservative outside of edge cases. Basically, the way we're doing the adjustment here is going to mean we're effectively doubling the p-value or cutting statistical significance in half. And second, in order to do this time shift inference, we're going to have to drop model releases in the last R days of the sample, where in the results I'm going to show you, we're dropping results in the last 199 days. Right? So basically, we're having to truncate the sample in order to do this shift. So that's part of why we view this approach as complementary rather than sort of a clearly preferable alternative to the permutation approach. So with that, let me tell you about our empirical results. So I'll show you a bunch of plots with this structure. So I'll go through it sort of pretty slowly this first time. So here, I'm showing you these beta hat H coefficients from the sort of regression plus accumulation I described earlier. On the horizontal axis, we've got a relative time relative to the model release at date 0. In the different panels, I'm showing you the event study for the 1-year Treasury zero coupon bond, 5-year Treasury zero coupon bond, up to the 30-year Treasury zero coupon bond. The dark gray or black line here shows you the mean of what this regression would recover when we run it in the placebo distribution. Right, so this says basically, on average, if we're picking the model release dates at random as I was describing, right, and running this regression, we would get sort of a mild downward slope here, mild upward slope here. The dashed lines are then showing you quantiles of that placebo distribution. So for example, the dark gray dashed line shows you the middle 90% of the placebo distribution. The next one shows you the middle 95%. The next one shows you the middle 99%. So the interpretation here is that when the blue curve crosses outside the dark gray line, that tells us the results are statistically significant at the 10% level. When it crosses outside the next line, that tells us they're statistically significant at the 5% level. So looking across these various plots, we see that, prior to, say, 15 days before the model release, the beta hat H's are tracking the placebo distribution pretty closely. Starting, depending on the series, maybe 15 days before, maybe a little less, we then see that the bond yields start to decline, where, especially for the longer maturity bonds, those declines become statistically significant and then persist all the way through the end of our analysis window, 30 days after the model release. Now, you might wonder, sort of, why is it that we're seeing these declines start before the official model releases? And one thing we can certainly say is that these labs are not hermetically sealed. So especially for some of the releases, we can concretely point to examples of folks saying online they had early access to the model, maybe for review purposes, maybe for other purposes, before the official model release date, which could help to explain why we're seeing some movement in bond yields even before the official model release date at date 0. Right, so the overall point here is our regression method confirms what we saw earlier, which is that we're getting economically large, right? So these are 10 to 20 basis point declines in long-term bond yields around these model release dates, where those declines are statistically significant and appear fairly persistent, going for at least 6 weeks after the official model release date. So here I'm repeating the same exercise, but instead of using a zero coupon treasury bonds, here I'm using zero coupon tips. Again, we see economically large and in some cases statistically significant declines in these zero coupon yields, which suggests that sort of the movements we were seeing in the nominal treasuries before are not due purely to issues around inflation expectations. So to complement those plots, here I'm showing you p-values, where in addition to the permutation inference results we had before, I'm also showing you results for the shift inference approach. Here I've got the various maturities we're looking at, and here I'm basically going to look at the change just at the end of the plus minus 30-day horizon. So think of this as looking at statistical significance at the very end of the plot I was showing you before. And we'll also look at a shorter event window going from 15 days before to 15 days after. In both cases, we see that we're getting statistically significant declines in treasury yields according to the permutation approach for both the shorter and longer event windows. And when we do the more statistically conservative shift inference approach, we're getting statistically significant or marginally significant declines for nominal treasury yields, although less significant results for the TIPS yields. Now, that result suggests that, coming back to the sort of initial framework that motivated this analysis, we are seeing investor beliefs shift around these AI model releases. However, if we think about a simple consumption-based asset pricing model, there are two things that are entering the stochastic discount factor for investors. One thing is the probability of an extreme event, right? So for instance, earlier I was talking about existential risk, because if I think I'm going to be dead in 10 years, that changes my incentive to save. While the other thing I could be thinking about is the future consumption growth process, right? So maybe I don't think AI is going to kill us all, but I do think it's going to make us all much richer or poorer, right? And that's also going to show up in my stochastic discount factor. As I mentioned earlier, both of these are going to move bond yields in the same direction, right? In particular, if there's a higher probability of extreme events like existential risk, or I start to expect better consumption growth, both of those should lower my future marginal utility of consumption and thus result in higher bond yields. Hence, if all I'm looking at is sort of the directional change in bond yields, I'm not going to be able to tell these two things apart. However, it's worth noting that if you think about extreme events, right? So basically think about either existential risk or consumption going to infinity. Both of those are going to imply that in the future, I think I'm going to have zero marginal utility of consumption, right? But in the state of the world where I have zero marginal utility of consumption, no other risk really matters to me, right? If I have zero marginal utility of consumption, I don't really care, for instance, what inflation is going to be. Moreover, if we compare the sort of TIPS yields and the nominal treasury yields, right? The distinction is that treasuries have inflation risk, while TIPS are at least supposed to protect us against those inflation risks. And you can show that what that's going to mean is that if information arrives which changes investor beliefs only about the probability of an extreme event, right? So sort of there's a new AI model release, but the only way in which it moves our beliefs is, say, the probability of an existential risk or the probability of consumption going to infinity. That's going to have the implication that actually the ratio of nominal treasury and TIPS yield should be roughly constant, right? Because basically in the state of the world where I have zero marginal utility consumption, I don't care about inflation. So if all that's happening is that I'm changing the probability of that state of the world, the ratio of yields turns out to be constant. And we have an argument sort of sketching out why that is in one of the footnotes in the current version of the paper. However, if we actually look in the data, that's not what we see. So here, I'm doing a calculation involving the ratio of nominal treasury over TIPS yields. Here we've done the ratio and then inverted it a bit so it's sort of more interpretable in terms of the stochastic discount factor. So what we see is the ratio is not moving much at these sort of shorter, on the horizontal axis here, rather than time relative to the event, I'm breaking things out by maturities, right? So this is telling us about the ratio of nominal treasury and TIPS yields at 2-year maturity, 3-year maturity, 4-year maturity, and so on up to 20 years. So what we're seeing here is that on average across the model releases in our sample, we're not seeing a big shift in what this ratio is doing at shorter maturities, but we are seeing a shift in long maturities. And once you sort of work out what the signs here mean, the shift at long maturities is in particular telling us that is consistent with basically long-run inflation expectations dropping on average around these model releases in our sample. Directionally, that's interesting, but for our purposes, perhaps the more important thing is this tells us that the drop we're observing in bond yields doesn't appear to be just about the probability of extreme events. That is, it's not just that, say, the probability we're assigning to existential risk is changing around these model releases, because if it were, the model has the prediction that this ratio should be approximately constant, and it's not. Okay, so that suggests, at least, that under this simple model, investor beliefs about consumption growth ought to be changing around these model releases. Right? And directionally, the interpretation is that if bond yields are going up, that says we're getting good news for consumption growth. While if, this is bond prices, that should be bond yields go up, that's good news for consumption growth. Bond yields go down, that's bad news for consumption growth. However, there's still an interpretation issue there, because consumption beliefs could be changing around AI model releases, either because investors think AI is going to be good for consumption and are disappointed in the rate at which AI is progressing, or because investors think AI is going to be bad for consumption and progress in AI has been very fast. Right? And to distinguish these two, we would like to know whether the model releases in our sample were good or bad news for the rate of AI technological progress. Right? That is, were investors positively or negatively surprised by sort of the technological progress represented in these various releases. So, as I already suggested, in order to answer that question, we're going to use data from the online prediction platform Metaculus, where in particular, the question we're using is about the expected arrival date for a particular definition of AGI. What we'll do is for each model release in our sample, we're going to sort of categorize that model release based on the change in forecast on Metaculus from 15 days before the model release to 15 days after, where those releases will be grouped into either releases where things were slower, right, where the expected arrival date for AGI got pushed back further into the future, or releases where it's faster, right? So the expected arrival date for AGI was brought forward, showing good news for AI technological progress. So here, I'm repeating the event study analysis I showed you earlier for zero coupon nominal US Treasuries, where I've now split the model releases into ones where progress was slower than expected and ones where progress was faster than expected. The key point to note here is that when we look at the model releases where progress was slower than expected, the observed change in bond yields looks actually fairly consistent with the placebo distribution, right? We're not getting statistically significant effects at most horizons. By contrast, when we look at model releases where progress was faster than expected, we again see that things are tracking the placebo distribution fairly closely at the beginning of the event window, but then we're observing large and statistically significant declines later in the event window, where those declines persist through the end of the sample period. So again, the interpretation here is that the declines in bond yields I was showing you earlier really appear to be concentrated around those model releases where folks were positively surprised by the rate of technological progress. This is repeating the same exercise for TIPS yields. Here, arguably, you actually see TIPS yields rise in sort of shorter maturities around these model releases for the slower case. But the declines in bond yields are again being driven by sort of what's going on around these dates where progress was faster than expected. We can again sort of do the p-value version of this, where we're incorporating both the shorter event windows and the shift as well as permutation inference approach. Here, I'm showing you the p-values for those events where there was bad technological news, where progress was slower than expected. And what we see is basically there are not really statistically significant effects here, other than maybe a marginally significant effect for TIPS at the shorter horizon, as I mentioned. By contrast, when we look at model releases where progress was faster than expected, we again see that those declines we observed are statistically significant, where now they are also statistically significant according to the more statistically conservative shift test. Right, so it really does look like we are seeing statistically significant drops in bond yields around these events where progress was faster than expected. Another thing we can do here, the sort of third inference method I briefly mentioned, is to look at the rank correlation of yield changes with the forecast revision across event dates. Right, so the idea here is basically to look at, is it the case that, say, the events that had the largest drop, right, or largest sort of positive surprise in the rate of technological progress were also associated with the largest drop in bond yields. Again, if we do things that way, we find that the relationship is strongly statistically significant. Okay, so hopefully I've convinced you that we are seeing movements in long-term bond yields around this collection of AI model releases. The next thing I would like to do is to try to interpret what might be going on here through the lens of a model. So as I already said, right, bond yields should, under a consumption-based asset pricing model, should be informative about investors' expectations for economic growth, but also their expectations for the probability of extreme events. So say existential risk or consumption going to infinity. So in this section, what I'd like to do is sort of take this perspective a little more seriously and try to translate the TIPS yield declines that we've observed to changes in investor beliefs, where we'll try to do this through the lens of the simplest model we could think of that would let us sort of do a quantitative exercise here. So specifically, we write down a simple discrete time model with a representative agent who has time-separable CRA utility for consumption. This agent thinks that the growth impacts of AI are going to kick in at some future date. And in each period, they have log normal beliefs about what those growth impacts of AI are potentially going to be. At each time period, they also perceive a constant arrival probability of existential risk from the period at which this AI effect comes in, or alternatively, a constant arrival probability for consumption going to infinity, where we show in the paper that these two, existential risk and consumption going to infinity, have the same asset pricing implication under the model, so you can't tell them apart. Using the model, we can back out a model implied forward rate schedule, where we show that, again, under the model, changes in both expected growth and existential risk are going to affect the level of this forward rate, of this forward curve. While changes in uncertainty about growth, right, if I become more uncertain about the growth impact is going to be, that's going to change the slope of the forward curve. Where the intuition is that because the growth effects of AI accumulate over time, uncertainty accumulates as well, which basically means that a change in uncertainty should affect the long end of the forward curve more than it affects the short end. We further write down a set of assumptions in the paper under which a simple difference in differences of log forward yields estimates these level and slope effects. If we take that model to the data, what we find is that consumption growth uncertainty, right, sort of changes in my uncertainty about what I think the growth effects of AI are going to be, do not appear to explain our findings. Basically, if what was happening was that I was becoming more uncertain about the growth impact of AI, that would predict a larger drop in forward rate, in the sort of forward rate at long versus intermediate maturities. When instead, when we look in the data, we actually see what looks much more just like a pure level shift of the forward curve. However, we do see this large and statistically significant drop in the level of the forward curve, where if we attempted to explain that drop purely by changes in growth expectations, then under the assumption of CRA utility, if we further assume the CRA coefficient is equal to 1, right, so we assume log utility, this would translate to a minus 9.3 basis point drop in annual expected consumption growth per model release, right? Which at least to us seems like a very large number for an event that happens 30 times over the sort of 3-year window we're looking at. If we increase the risk aversion coefficient to 2, that drops the implied growth, that cuts the implied growth effect approximately in half. So it's about a 4.7 basis point drop per model release. Alternatively, if we instead try to explain what we're finding purely by changes in existential risk or the probability of consumption going to infinity, then this would again imply a 9.3 basis point drop in the annual arrival probability of this extreme event per model release. Although the results I showed you earlier, basically showing that we get this change in the sort of treasury TIPS ratio around our model releases, does suggest that sort of it can't just be changes in these extreme event probabilities, at least under the model, that are driving what we find. Okay, so in the little bit of time I have remaining, let me briefly show you results for some other financial series in case of interest. So far, I've focused on US government bonds, right? Either nominal treasuries or inflation protected bonds. But we can do the same exercise for other financial assets. So here I'm looking at some corporate bond indices, again, broken out by maturity and by whether the progress around the given model release was slower or faster than expected. Again, we see that around the releases where progress was slower than expected, we don't see sort of an obvious change in corporate bond yields. While around the releases where progress was faster than expected, we see large and statistically significant declines in corporate bond yields. In addition to just looking at corporate bond yields on their own, we could also look at corporate bond spreads, right? So for instance, right, so basically what's the sort of premium yield being paid by corporate bonds relative to US government treasuries, where this could be interesting to look at, for instance, if you thought that the information arriving around these AI model releases was changing the perceived riskiness of corporate bonds relative to treasuries, either because maybe it's making you think companies are more or less likely to default, or because it's changing your perceived probability about a US government default. When we do that, though, we see that basically we're not getting statistically significant declines in bond yields or really declines that look notably different from the placebo distribution for either the slower or faster releases, right? So it doesn't seem like the drop in corporate bond yields or treasury yields is explained by a change in relative risk. To look more directly at the sort of implied risk of a US sovereign default, we can also look at credit default swaps on US government debt. So here we're again doing that event study on these credit default swaps broken out by slower versus faster events. Again, here we arguably see some margin significant results at the beginning of the period for the faster events. But certainly by the end of the period, we're not seeing sort of economically or statistically significant changes in these credit default swap prices around either the events where progress was slower than expected or faster than expected. We could also look at the effects on exchange rates. So here we're showing results for a US dollar index, again, split by slower versus faster events. When we look at the events where progress was faster than expected, we're seeing a marginally significant decline in the US dollar exchange rate by the end of the sample period, although it's not as pronounced as the changes in bond yields we're seeing earlier, and does look consistent with, for example, a fall in demand for the dollar following lower exchange rates. Finally, we can look at the volume of trade in US treasuries, again, split out by slower versus faster. If I stare at these pictures, I could tell some various stories, but I'm not seeing something super obvious that's going on. We also do a variety of robustness checks to try to kick the tires on this and make sure that what we're finding doesn't appear to be entirely spurious. So we can repeat our analysis, dropping 1, 2, or 3 of the event dates in the sample. We can control for the arrival of other news. We can look at basically whether the changes around these AI events are larger than the changes you would get around alternative event series. So say FOMC meeting dates, treasury auction dates, release dates for various economic data, or dates of major tech conferences. Again, you can see the appendix to the paper for the current version of those if you're interested. We find that the changes we're observing around these AI model release dates do not look like what you see around these other series. Finally, we can also redo our analysis looking at subsamples of the data, right? So basically, we could just use the data from 2022-23, just use the data from 2024, or just use the data from 2025. When we do that, we find that the results for 2022, for sort of 22-23 and 2025, both look sort of qualitatively pretty similar to our main sample results, while the results in 2024 are more muted. So to conclude, we find our conclusion from these results is that markets do appear to believe in transformative AI in the sense that bond yields are responding to the information embedded in these AI model releases. However, counterintuitively, at least to us, we're finding that bond yields fall in response to AI progress. So AI model releases that are sort of faster than expected, that represent more technological progress than expected, at least as measured in the Metaculus data, are actually associated with lower yields on these bonds. Now, we're very much in the market for explanations for what could potentially be going on here. But some possible hypotheses are, first, that investors in fact think that faster AI progress corresponds to lower consumption growth, that these model releases associated with faster progress are also associated with a decline in the probability of extreme events. Although the results I showed you earlier suggest this probably isn't the entirety of the story, at least under the simple model. Or, of course, there are many ways in which the simple model we wrote down could be wrong. Right? For instance, perhaps investor belief changes around our model release dates are in some way non-representative. Right? Maybe folks are overall optimistic about the consumption impacts of AI, but somehow these releases made them more pessimistic. That doesn't seem super likely since we sort of tried to pick a well-defined universe of dates, but it's certainly possible. You could also tell stories about changes in model uncertainty or ambiguity aversion around these model releases. Perhaps, maybe the issue is folks are worried about breakdown of the labor market, and because of incomplete markets, sort of can't insure themselves against that. Or you could tell other stories about sort of non-separable time preferences and sensitivity of time to the timing of uncertainty resolution. But other hypotheses are very welcome. So with that, that's what I wanted to cover today. So let me pause here.
Thanks, Isaiah. This is a really informative and actually somewhat surprising presentation of the results. We do have some questions already in the chat box, but I do want to take advantage of being the moderator for today's webinar to ask a question before we go to the chat box. I actually want to focus on the sort of econometric approach here. We are dealing with still a relatively small number of events and releases. I guess the focus on median and the use of permutation inference would help assessing the significance. Is that something you believe is broadly applicable to this type of setting? And also turning that back to the paper, what does that tell us about whether AI is special here? It sounds like the exercise can be done for other technological progresses, or it might be able to allow us to do some access even before 2022, right? There were earlier releases about AI technology that's not so much about large language models, that's not so much about the general populace, but there were earlier language models or AI models that were released as well. Can we sort of do that exercise here as well?
Yeah, so great question. Thank you very much. So yeah, so brief answer, yes. So the sort of techniques we're using here, so either the permutation inference, which is in the posted draft, or the sort of time shift inference, which is something we've added now, both of those apply much more broadly than this specific context. Now, I think the trade-off there is that the advantage of both of those methods is that they are valid in small samples. The downside of these methods is that in if you have enough samples, if you have enough observations that, for example, the sort of usual standard errors would be totally reliable, these methods are going to tend to be more statistically conservative. That is, they're going to tend to give you less power. Now, in our context, we think that's a worthwhile trade-off, right? At the end of the day, we don't have all that much data, and so we sort of are willing to accept methods that are sort of more statistically conservative in exchange for being confident that, like, if we see a signal, there is in fact likely to be something there. But I think that's sort of the trade-off. But in other settings where one has a relatively small sample and is looking for sort of big signals, I think these are very useful tools to use because they sort of can handle the small sample issue. Now, to your question about sort of either looking back further or using data on sort of other, sort of pre-ChatGPT model releases or even other sorts of technological progress, I think that's also a super interesting question and do think that is something one could potentially do. I think one aspect for our purposes that's a little tricky is precisely because these methods are statistically conservative, sort of we have the best chance of finding something or sort of learning something useful if we look in periods where we expect the signal to be large. And so part of our reason for focusing on what happened after the release of ChatGPT was our sense that basically post ChatGPT, the amount of attention that was being devoted to AI sort of increased dramatically. So we thought we'd have a better chance of basically, to the extent there were responses, finding them in that period. But absolutely, one could apply these techniques elsewhere as well.
Got it. So to the extent that some other technology has a similar release pattern or market reaction pattern,
Mhm.
we can apply the framework as well.
Absolutely.
Let's take a question from the audience. Actually, I'm going to read this question from Joseph Chen first. So the question is about, would you interpret the price responses as reflecting beliefs about AI's intrinsic technological capabilities or beliefs about our ability to manage and constrain those capabilities over time? I guess the last part can be even extended further. Is it about how the market coordinate versus, something more fundamental about the technology?
Yeah, that is again a really great question. I mean, I guess sort of if I if I take the sort of simple consumption-based asset pricing model very literally, right, which in some sense is like the starting point of the project, I guess what I would say is I think it reflects a combination of both of those, right? Because in some sense, under the simple consumption-based asset pricing model, it just reflects, how does the arrival of this new information about AI change my perceived, change the representative agent's perceived probability of different consumption growth paths cross different existential risk paths in the future. And so to some extent, if you say, I think AI technology has a huge possibility to increase the consumption possibility frontier, but I think we're going to manage it very poorly and therefore the effects are going to be bad, versus I think AI, the only possibility is that AI leads to a bad outcome. Well, simply using the sort of consumption-based asset pricing model and asset prices, I don't think we can tell those two things apart because basically they both lead to a similar consumption path in the future. And that's sort of that perceived consumption path is what's going to drive asset prices. I think there's a very interesting question of whether there are additional data sources or modeling assumptions under which you could tell those two things apart, but I don't think I have a good answer on that now.
Makes sense. There's also a slightly more general question from the audience. I
Mm-hmm.
think Jihu was asking, what type of problems, right, can AI solve in the operations of the Federal Reserve or in stock market or in other financial institutions in the United States? And after AI has completed the corresponding business mentioned above, what can humans do in the remaining of the business? I guess that goes a bit beyond the paper per se, but it would be great to hear your perspective, because this is a really something that's affecting everyone's life, every sector in the economy.
Yeah, I mean, I guess so. So I guess the angle we've been focused on in this project is sort of much more in the vein of, what do at least what do markets seem to, or what do investors seem to think the sort of aggregate effects of AI are going to be? Where there's another question of, if you have a given set of aggregate effects, right? So imagine I adopt the story that the change in bond yields we're seeing is because folks think there's going to be large labor market disruption from AI. Well, presumably, if there's large labor market disruption from AI, that's because some new generation of AI tools is able to do some large set of jobs, right? And then the question is like, what's the stuff left for human beings to do, and what are the effects of all that on, the economy, on consumption, on all of that? So I guess I would say it certainly seems very plausible to me that that some of these AI tools would be able to do a lot of tasks in the economy. And I think there's some very good work going on at the moment of folks sort of trying to explore how does that look right now. But I think what our project sort of speaks to more is basically what are markets suggesting they think these aggregate effects might be, where there's a lot of the sort of micro stories about particular tasks or particular jobs that presumably underlie that. But I don't feel like I have a ton of specific insight into that.
It's already great to hear your perspective on that. It's a more general question and challenging question. Jay Liu also has a question about, who drives the changes in bond yields. I was thinking about this as well, right? So if we think about the episode before the ChatGPT and all that,
Mhm.
probably institutional investors who trade bonds anyway are the ones who are following, the releases of BERT and some earlier models. So it's not the mass population that's really
Yeah.
playing a role or impounding their reactions into the prices. So if the institutional investors are driving it, what's the implication, right, in combination with what is observed here?
Yeah, I think again, I think that is a fantastic question. And I think, right, the starting point of our paper is sort of the very simple, complete market representative agent consumption-based asset pricing model. And in that model of the world, right, basically the beliefs or the utility function of the representative agent is going to reflect basically a wealth-weighted composite of individual investors. And so I guess what I would say is in that set of the world, in that sort of model of the world, the representative agent should basically represent a wealth weighted average. So it should disproportionately represent the beliefs of sort of wealthier investors, which again, to me, makes it a little surprising. We're seeing an effect in the direction we are because you would think, for instance, if there were big labor market concerns, you would expect those to be much more relevant for the less wealthy rather than the wealthier investors. Now, if I sort of step away from that complete market representative agent world and I sort of say there's institutional investors, there's this, there's this, there's this, and because markets are incomplete, I sort of can't aggregate them all up into just one representative agent. I think that's a super interesting question of whose beliefs are driving these asset price responses, to which I, again, unfortunately, don't feel like I have a super great answer.
And I guess currently the model is also not looking into the heterogeneity too much, right, of the agents in the market.
Yeah.
Yeah,
You could sort of, it's easy to sort of say people with heterogeneous utility functions, and you could put that in, but exactly beyond that, you're basically getting an aggregate.
right, right. We also have a question asked live. I think Yingju has a question. Yeah.
Oh, yeah. Thank you, Will, and thank you, Azza, and thanks for the great presentation. My question is that, like, over time, I think we have seen that the response to the release of every new models seem to have slowed. And now, I think, well, more interest shifting to new business models, such like agentic approach,
Mhm.
like the coding. So
Mhm.
I'm curious how this framework can handle such shift in the interest, what the market response to AI, not only the release of new model, but some other business model, or if you find anything I'm just curious.
Yeah, so that's a fantastic question. Thank you very much. And I think
Okay.
part of what we were expecting when we started out this analysis was that maybe we would see sort of, I mean, when we started out the analysis, we expected to see probably nothing or a noisy zero. Um, to the extent we saw something, it seemed very plausible that effect would be dropping off over time. Let me actually briefly scroll forward to show you the results broken out by year. Um, so these are the results for releases in 2023, 2022, 2023, right? Where we see sort of a similar pattern to the full sample results. Basically, the releases where things were slower than expected, we don't see a lot, while we see declines in bond yields around the faster releases. Uh, Here are the results for 2024, where, as I said, basically the pattern is much more muted, right? We're sort of not seeing, at least to my eyes, a super clear pattern in slower versus faster. But then here we're back in 2025. And again, we see slower releases. The sort of distribution looks quite close to the placebo. Faster releases, we are again seeing these declines in bond yields. So all of this is just to say to your point, I totally agree that sort of you would think that just anecdotally, it certainly seems like as time progresses, there's more attention being put on, for instance, you know, various things one can do with the models, various tools one can build around the models, rather than sort of the progress of the underlying model itself. But interestingly, we do continue to see this pattern of decline in bond yields, even just using the data from 2025. So I don't know quite how to reconcile those two things, but I guess that's what we're finding.
Yeah, thanks a lot. Thanks.
Thank you. I'm sure there are many more questions. For one, I'm curious to hear Isaiah's thoughts on how AI is actually affecting econometricians, right? And I was just reading about causal machine learning and doing some work on that. And I realized that what computer scientists are calling causal machine learning is not really causal to economists. So, but we might have to save that to a future occasion in the interest of time. So let's give a round of applause to our speaker, Isaiah, again. Thank you.
Fantastic. Thank you so much for having me, and thank you for the great questions.
Thank
Yeah,
you.
so that's a really thoughtful presentation, and I think the paper really forces us to think carefully about how the markets interpret technological changes, and I guess it also highlighted how belief updating around AI is, it's more subtle. It's not what the narratives typically suggest. So once again, I want to thank Isaiah. Thank you all for joining us today, and we hope to see you again at future Luohan Academy webinars. Thanks,
Fantastic.
everyone.